Hey, welcome back. Despite being up significantly in recent history, AMD is down like 40-50% from its 2024 peak. Now, with some new opportunities but also risks, let's see if this might be a good time to get in. Q4 was okay, with improvements in margins, revenue and pretty much everything, but the stock fell by like 10% at some point during the day. I don't have a position in the company and I'm not trying to defend them, but it's the same with all the high expectation stocks. You can have an amazing year, but say anything below expectations about the next year or even quarter and you crash. Despite literally doubling the revenue and tripling the operating income in data centers, where the market pays attention due to Nvidia, the outlook was only 30% year-over-year growth in revenue in Q1. They expect the second half to be better, by the way, but the market still worries that they might have issues catching up, but more on this later in the video. They have a focus on data centers, gaming and of course AI, generally being the number 2 or 3 in market share after Intel and Nvidia in pretty much anything. Data centers actually deliver some triple-digit growth in revenue, now being a significant side of the company. I guess they summarize the company very well in this slide. A tech leader growing in AI and data centers, very strong balance sheet as you are about to see, and so on. We see them developing well up to a certain point, but now it's pretty flat. The issue is that the company's profitability is also very low, in the single digits even. Not only that, but everything is below the 5-year average and the past few years haven't been amazing for them, despite all the AI and hype around it. I mean, Intel has similar issues, but we've seen a very different response from the market. AMD is only now beginning to fall. They can make 1.5, 2, maybe 3 billion per year, which is terrible for a 200 billion market cap or close to 400 a year ago. Obviously, nobody is buying it for what they can do now. It's a bet on the company doing extremely well in the future, and right now it's not really doing it, so the market is adjusting. But at the same time, Intel is less than half of them, despite having potential to make even 10 times more, so the market's pessimism can really show. Financially, we see a very good position, with the current assets covering all the liabilities and almost no debt, which could be an opportunity. The equity is about a fourth of the market cap, which is kind of normal for this kind of company. However, we see a lot of goodwill and other intangibles because in the past they did significant acquisitions, even one in 2024, and developed a lot thanks to that. Now, a significant issue I have with them is that they kept issuing stock and developed well, but they stopped in 2022 and so did the growth. Why stop when you get to literal all-time highs with such a high valuation in this environment? Today, if they diluted 10% and invested that money at the same low margin they have now, that's basically doubling the cash flow. There is so much they can do with that kind of money, especially if governments are helping. By itself, without the market's help, this company is too small to support a 200 billion valuation. That's 8x the revenue when the margin is below 10%, so they'd have to grow a lot, which is very hard without money. They could even buy Intel or a part of it, despite being an actually much smaller company because of the market caps. This way they wouldn't be fabless anymore, wouldn't rely on TSM, and would have a ton of market share in pretty much anything, not to mention that it's cheap and they would instantly win on the value. But again, they bought something recently, so maybe that was just a small break. There are a bunch of studies, but in general I see an expected compound annual growth rate of around 30 to 35% in the AI market size by 2030, which is very high. Obviously, companies like AMD are vital for this, but at the same time this is a very dynamic industry and projecting so far into the future can be very tricky. Some unpredictable disruptor could potentially make it even better or much worse. I mean, the current AI market is in a very new state that we couldn't really predict half a decade ago. AI itself isn't new, obviously, but the recent advancements, uses, disruptions and so on are a significant step forward. Now, with China's DeepSeek, we see that maybe you don't need the best tech to perform in AI. Someone might have been lying or artificially inflating prices if China was able to do the same with limited access to Nvidia's tech at like 10% of the cost. So Trump's 500 billion investment in AI may have to be reworked. Anyway, this is the kind of disruption you can expect in the market, so this is why valuing this kind of company should be very carefully done. Again, this is why stopping the dilution and basically the significant investments was such a bad thing to do. If they are behind in tech and the market realizes, the stock falls, meaning they won't be able to take advantage of the valuation like today. And that's how the company ends up in, let's say, mediocrity. You know, a significant line of basically free money would be gone and they would fall more and more behind. Even if the company is doing okay, if the market sentiment is gone, that's basically it. But if the whole thing about the performance and costs is true, that might not be bad for AMD and even Nvidia. If anything, basically making AI and data centers cheaper to operate would encourage the demand. So sure, the higher end tech is affected and they might have to rethink the prices, but the mid and lower end, especially the ones that they could develop now, might see a lot of growth. If they play it right, they could potentially win a lot from the volume. But again, that's if everything about the cuts that the Chinese company who made DeepSeek said is true. Now let's see a valuation. If they disappoint the market and don't manage to grow above 3 billion per year, which could even mean double the revenue, let's say the ratio is at 20. That's still very high, but then they would be around or even below the equity, so maybe there is kind of a bottom. That's a 60 billion market cap, meaning a price of 36.9, so a 60-70% loss. But keep in mind that if they do it through issuing shares, that's a lower price since you have to divide the market cap in more. Again, it's all about the market's confidence, and if that's gone or even just affected, this can drop significantly. In a second scenario, with some growth but also competitive pressure, let's say they get to 5 billion per year. Again, the revenue to get there could even more than triple, so there is plenty of growth. For a ratio of 25 to show some market confidence but also worries, that's a 125 billion market cap. That's a price of 76.87 for a 30-40% loss. Again, if they issue to get here, which they probably would have to, it's even more. Now, let's say they keep doing acquisitions, develop and take a good market share, especially thanks to AI, and get to a 10 billion cash flow in half a decade. For a ratio of 30 to reflect a dynamic and competitive environment but also some market confidence, that's a 300 billion market cap. That's a price of 184.5, meaning a 60% profit. Yes, the ratio can be 40, 50 or even more if you look at Nvidia, but Nvidia 10x the revenue since 2020, AMD only tripled it, so can they grow like that? But who knows how the environment will look in half a decade. Maybe they even buy Intel or Intel buys them, who knows. Sure, it can do much better, but it's just not enough to justify a buy in my opinion. Paying like 8x the revenue of a company with a less than 10% margin assumes some insanely high growth expectations. Again, it can happen and this company can be amazing, but if it happens, the upside is not that high. And if it doesn't deliver because of the market, maybe politics or some more disruption from China, then the downside is very, very deep. Look at what happened to Nvidia or ASML recently when reality hit the market. Just because the stock fell and it's cheaper now, it doesn't make it cheap. The company itself is okay and healthy, but this is not a $200 billion company. If they were smart, they would use this very high valuation to issue stock and actually deliver some growth. And if you think it's uncommon or something, Amazon is doing it. That's how they develop. Dilution doesn't have to be bad. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.